Welcome back, everybody. I am your designated inquirer. My name's Axel, and today is 8/7/2020. Today's a Friday. Happy Friday, everybody. Hope if you have them, have plans for the weekend. If not, hey, that's cool. You got work, but I hope your Friday is something you can enjoy. Anyway, today the market finally made some sense. I'm so happy and sad at the same time. Because it makes sense, it means something bad happened, which is that the market went down. The market finally went down, at least a little bit. If you're seeing a whole bunch of things that you're not used to seeing on this talk that I do, it's because I'm going to show you a little bit about a subject that I want to teach you about, and that is mean reversion. And mean reversion is a good way to explain a lot of different things that happen in life from an engineering perspective, from an economics perspective, but also from a political perspective. In all aspects of life, whether or not it's socioeconomic, etc., whatnot, or just, personally. Mean reversion can help you to try and predict what might happen in the future. Now, today's dip was a little interesting, because while the market did not take into account what it should take into account, which is job numbers, that while it added 1.78 million jobs, which was still over the estimated 1.4 million jobs, it still came down from 4 point, let me get the number right. Whoop, not that. Let me get the number right. The number is yahoo.com. We can go to Yahoo Finance. And when you go there, I'll just show you guys. When you go there, you go to Finance Home. Here it says mixed with job status, stimulus, etc., whatnot. Boom. You can go down. And take a look at what it was, right? So here it was basically 1.8. The estimated was this, and it came down from a number of, where is it? I think it's like 4.7 million, right? 4.7 million was the number that it was last month, or basically June instead of July. Right now we got July's numbers because jobs numbers are a lagging indicator, because it's reported to the BOE, it's aggregated then reported, and then they give the breakdown per sector, per state, per city, like all the information about like where jobs were created, where they left, a lot of different information about the kind of unemployment that we're seeing in terms of, are they discouraged workers, are they workers that left even what's called the labor force, and that they're so discouraged that they're like, fuck it, I'm not working anymore, somehow, if they were able to do that, right? Like a lot of interesting things you can discover in a jobs report if you so choose, to try and dig it up. You can if you want to, but you don't have to. Anyway, so the number came out, which was a dip of like almost 50%, a little more than 50% dip in job creation, and yet the market went up, right? But they didn't see it as that. They saw it as, oh, we made more jobs than we expected to make. Cool. And so, they decided to rally, which is, to me, is a little insane. Up until, if you can take a look, wait, right up until, if you look at what just happened in the day, this was before the market opened right here. As you see, it was a lot lower volume than when it opened right here, right? This is where it opened. It went up to about this point, or actually to about this point. Then we started getting information about basically the stimulus negotiations, and this is where it basically started to tumble, and all the way, basically tumbled from here all the way down to there, which is equivalent to, wait for it, 2%. When a 2% drop on no progress on negotiations for stimulus. And soon thereafter that, basically when they decided to call it quits, soon after that they started like, oh, but we're not done talking yet. Oh, but the president's gonna put out executive action on blah 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 blah. Like, we don't even know what he's gonna do. We don't know what he's gonna do. We don't know if he can do it. We don't know if it's legal for him to do it. But he doesn't care. He's gonna try and do something. You know, bless his little heart. Anyway, so now what, right? Okay, so we're here. And we're looking at these graphs. What does it all mean? Okay, so if I take a step back right here, this stuff right here. If I can zoom out, let me go ahead and zoom out here. If I'm gonna go by, I'm gonna go by day. I'm gonna zoom into this area right here. This is a month's time. Okay, so this right here. On the right, okay, so I gotta go this way. All right, so starting from this date right here, up there, starting from that date is the start of the month. Okay, from this start of the month right here, it starts to aggregate the price and the volume executed at that price. So it starts to make a graph. Okay, so this is called a volume weighted graph, as in terms of like what price executed the most volume. And so this gives you an indication as to what price the market liked best, what price the market paid most at, right? So the highest liquidity was found at that price, at this black bar right here. This black bar was basically the highest volume, the price at which the most shares were sold. Of this case, of the NASDAQ. The NASDAQ 100. So, now that we have that information, as one of the indicators that, you know, people tend to look at, we also have what kind of amounts to Bollinger Bands and a line that is called the VWAP, or volume weighted average price, VWAP. Okay, so that's another indication as to like where the market can go, etc. I have some that happen to be weighted only off of the price itself, the average price over a given amount of time, and basically the average over that time gives you a point. Then you've got down here, which is right there, this area right here, which is your MAC ACD, which basically gives you some sort of measure of momentum, where the difference between the two lines when they cross each other, etc., whatnot, is the space right here shown in the green and the red bars. Now that's momentum. Here, down here, is basically what people tend to call RSI, or Relative Strength Index. What's important about a lot of these different indicators, which may seem very messy if you're not used to seeing them, all they're really good for is to try and tell you when mean reversion might happen, when we might start to see a swing in the opposite direction. Because it's not always the case, because people are crazy, the market is crazy, and it's going to do what it's going to do. You can't necessarily fight with it. You just got to accept that it went somewhere, because as individuals, we don't have enough monetary power to influence the direction of the stock market in and of itself by ourselves. We are just subject to the whims of the market to a certain extent, because there are hedge funds, there are a lot of different like retiree funds, etc., like that have enough money to be able to move entire indices if they so choose. You don't believe me? Let me prove it to you. On QQQ, which is a derivative market of the NASDAQ. Okay, it's called QQQ. All right, this one every now and again has some fits. It'll go places and it'll do things that, you know, just don't make any sense whatsoever. I can remove this one right here. Yes. And every once in a while, like right here, you see this bar right here? This is somebody entering a fat finger order, meaning that they ordered more than what the market was able to provide. And sometimes you end up fulfilling an order that was way down here. That somebody had entered way down here and then forgot about it and put it into extended hours, and then somebody snatched it up and said, I'll sell it to you, because they wanted to sell all of their stuff up there, and one person really wanted to buy down there, and so they bought it because the person just wanted to sell all of their shares. There wasn't enough orders to fill at this average price, and so it executed at this price, right? But that's only for a single second in time. And so that's what happens when a relatively large amount of volume gets executed and overextends the amount of buyers and sellers in the market at any given time. Sometimes it can happen during the day, and can exacerbate the extremities by which a stock can go, like down here. Like generally maybe it would stop at this support line right here, but sometimes it can go further. Sometimes it can go above. That's why it's not necessarily perfect when, like I've said before, it can technically go beyond a certain level, but doesn't necessarily trigger a definitive breach of a support and or resistance line. Resistance lines generally are above you, support lines are generally below you. Now, going back to all those indicators. So, all of those indicators are generally used to give you some indication as to reversion to the mean. Meaning that if something may seem, let me go back right here. So if something seems to have been overbought, meaning that a lot more people were buying, willing to pay a higher price, running the price up on something because they're just, there's a frenzy for it. There is not enough supply to meet the demand, and so the price keeps going higher, and you get to the prices that you do. During that time, relative to a particular price or factor, because I don't even exactly know how this indicator works per se, and I don't know the underlying function of the indicator, so I couldn't tell you exactly what math is used to indicate what number, but I know enough about what it does. It can go above either a 70 and or below a 30 and indicate whether it's overbought and or when it's oversold. When either or happens, okay, when statistically you have a higher chance, statistically it's not a foregone conclusion, statistically you've got a higher chance of it moving or reverting to the average, which is 50%, reverting to the mean, and or swing in the other direction. Sometimes it can swing and move completely from one end to the other, from completely overbought to oversold within a matter of days. It can happen depending on your time frame, because this can change by time frame. If you go to 1 minute, you see a lot more ups and downs than if you go to a day, right? It can take a month to go between overbought and oversold sometimes if you're not careful, or if you're not looking for it, etc. So you got to look at a lot of different time frames and figure out exactly how you want to play your stock, your index, however it is that you best see fit. I'm not about to tell you what to do and how to do it. You go to a financial advisor and you ask those questions. I can only teach you about particular indicators, sometimes about how they work if I know how they work, and general things that happen to a market, because I'm an economist. That's it. Apart from that, do not take advice from me if I say like it feels like it's about, you take your decision, you do your own research, and you verify by yourself as to what decision you want to make for any financial action that you're gonna undertake. Okay, apart from that, I am not licensed. I cannot give financial advice. That is my fiduciary duty. I feel like I have to be responsible and tell you these things. Anyway, now that I have that covered, reversion to the mean. Now let's take down, we're going to go ahead and move to the daily. Okay, we're going to go to the daily here. Now, it's hit a couple times now over bot, right? It's hit over bot. Statistically speaking, we've got a good shot at turning this thing around and going and visiting oversold. Okay. When? I don't know when it's going to happen. How? I don't know how it's going to happen. But statistically speaking, we've got a decent shot at doing that. Okay. Just because you hit an oversold and or an overbought does not necessarily mean that you're going to hit the all-time high perfectly when that happens, okay? Because it could do it multiple times and you be stuck way down here before you end up seeing the actual drop. We don't know. I can't tell you because I don't know. And if anybody tells you first thing that they know, don't believe them. Do your own research. You work off of what you best know. Anyway, another thing that I can probably no, you know what? We'll save another lesson for another day. But those are the things that move the market today, and those are the items that I saw that were most prevalent to be able to explain what the market did. Now, let's go back to here. We're gonna see what else happened today. If there's anything else worth talking about. Interesting. No. Nope. 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 I don't really see anything necessarily worthwhile to mention and or talk about at the moment. Excuse my hair. It is drying. It is not greasy. I do take a shower every day. Yeah, that's it. So, if you guys had fun, if you guys learned something, if you guys find value in what I say and how I say it and how I go about doing this, please feel free to share this amongst your friends. Like and subscribe because it helps in the algorithm. It's just something that happens. Right? Hey, I like your Pokemon shirt. Hey, I like your Logitech headphones. Yo, I like your style. Hey, I like the way you speak. Anything. Go ahead and comment down below anything so that YouTube can see these points of data, because that's really what it is just points of data. If you want to write out 20 different comments just to say one sentence to help me out, go ahead and do that if you want to. I'm not going to judge. You do you how best you want to support the people that you like. If you want to do that on somebody else's video, feel free to do that. If you don't feel like you want to do it for my video, that's fine too. Anyway, thank you guys for dropping by. Thank you guys for sticking by to the end of the video. I appreciate your time. Stay safe, stay healthy, and until next time, I'll see you later. Take care. Bye.